The slides that we're going to talk about now come from the Market Pulse, which is a quarterly report. This time we're going to look at who's buying businesses, especially since, if you do remember, Q1, January and February were still pretty hot in 2020 for us here in the States. So it was just that mid-March or so and the fear going forth that changed. This is where we start to see a lot of differences that we haven't seen before. Q1 2020, over 50%. As Scott was saying, I don't think we've ever seen anything, any quarter for those who bought businesses for less than 500,000 that had less than a 50% as being a first-time individual buying, people buying a job. As you can see in Q1 of this year, less than 40% had. That is the lowest number. You can also begin to see that the strategic buyers starting to look. This came out even more in that $1 to $2 million range. Individuals were shrinking in the percentage, how many had bought it, while existing companies and strategic buyers increased. And 18%, that's a pretty big delta. That's really big. And then in the 2 million, we see a little bit of a change, but here's the big shocker. The individual who owned a business, they were leaving or buying another one in this first quarter. We had a jump of 22% in those individuals. But what we also saw was that the platforms or the PE group were not as interested in those $2 to $5 million businesses this past quarter.
Yeah, you can see how we talked about how there was few sellers and so many buyers that the first-time individual, either they didn't have enough money to do a deal of this size, or they just got squeezed out, that a strategic buyer or private equity that had to put money to work just outbid them. And so it's really small, and you can see that the strategic buyer went down quite a bit, but private equity went up. And I think the biggest reason that private equity went up is that family offices, companies, individuals do not have to deploy X amount of capital within a certain time frame, and private equity firms do. So the ones that with committed capital, they basically have a 10-year window. So they're like, hey, we can't take a break. There's not a lot of companies out there, so we've got to bid up the ones that are there, so we can continue to put money to work, and hopefully we can continue to build value within those companies and get a higher multiple we sell them, or get a little bit lesser return for our members. But they don't get paid to sit on the sidelines when things are a little dicey. That they had to kind of go all in, and you can see that they did in 2021 for sure.
And the thing that surprised us about this was the first-time individual buying in this price range. We have not seen that.
Yeah, not too often at all. Yeah.
So they were looking for a better return. One of those explanations are all those corporate individuals who left or were furloughed from their jobs.
Right.
And they moved into this because they're a good management system typically.
Well, I think one last piece on that too that we saw is that there's just, you can grow two different ways, either organically, hire people and grow, or a greenfield, or buy a company. And with everything out there, it was so hard to find employees, especially with all the different government programs and enhanced unemployment. I was on vacation down in Florida at a Marriott, and it was really understaffed. I said, boy, you guys seem understaffed. They said, yeah, when Biden's plan came out for the extra $300 a week, 30 people quit the next day, and now they're starting to get back into work. But it's been tough, especially in that hospitality space, to find the employees. So people are looking to say, hey, we're going to buy a company, and part of what we get is that human asset, or those trained employees. So that's been a big, a continued shift to acquisition versus internal or organic growth.